and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host, and I'm still the Inflation Guy. I'm not going to be the disinflation guy or the deflation guy because, you only get one trademark. Well, that's not true, but it would be weird to have both trademarks. Both Inflation Guy and Deflation Guy would be kind of odd. But anyway, that's what we're talking about today is the monthly CPI report. And good news. But anyway, good news, and but it's only 1 month. I guess that's the but. That's the only but. But before we get started, I guess that's the second but. But before we get started, I want to thank our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies. Perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. Of course, why do you need to diversify your equity and bond portfolios when equities and bonds are skyrocketing on a day like today? This podcast is also sponsored by Enduring Investments, which was founded to help institutions and individuals defend your money. Our unique strategies can help you if you're saving for your own retirement or for a group of retirees in Quebec or whatever other odd inflation challenge you are facing. We can also help with managing and hedging supply chain cost pressures if you run a business. Visit us at enduringinvestments.com. Okay, so I hope you enjoyed your 4th of July holiday weekend. I know that there are people listening to this podcast from around the world, and you didn't all have an Independence Day, but you all had a 4th of July. And maybe it wasn't a holiday for all of you. But anyway, I hope you enjoyed your 4th of July. And for those of you who took a long weekend or a week like I did, I hope you enjoyed it. And we come back this week. It's CPI week. It's CPI day. Always an exciting time. And interestingly, probably a little less exciting now this month, even though we got an exciting number, than it has been for a while because of what the unemployment rate is doing. And, obviously the Federal Reserve, which it seems like that's the only thing that the market kind of worries about is the Federal Reserve. But the Federal Reserve has what we call a dual mandate. It's really more than a dual mandate, but we call it a dual mandate. And in that they are supposed to try to minimize unemployment while minimizing inflation at the same time. And that's obviously not actually really, it's not possible to do those things simultaneously. And traditionally, the Federal Reserve has taken the approach that if we manage the inflation problem, then the cyclical stuff will be easier to take care of. We can worry about the recessions, we can worry about the unemployment rate, but we can only do that if we're comfortable with where inflation is. Now, we went through a long period of time when the Fed was very, very, very dovish. And the assumption, and my assumption coming into this, the current crisis, was that the Fed would continue to be ultra dovish. Not just, and obviously they were ultra dovish in COVID, but even coming out of COVID, my assumption would be that the Fed would not hike as aggressively as they did. I was surprised by the way they addressed that, but that is kind of what historically they've always sort of focused on. And Greenspan articulated that in as many words, that if we can keep inflation low and stable, that's the best long run. That's the best way that we keep unemployment rate low and the economy stable in the long run, is by addressing and keeping inflation low and stable. But it hasn't always behaved that way. Under Bernanke, under Yellen, it was a very different central bank. And under Powell, sometimes they go one way, sometimes they go another way. But over the last year or two, certainly it's been a fairly responsible central bank. But anyway, so the Fed has been focused more recently on the unemployment rate because the unemployment rate has been rising. And typically when the unemployment rate gets about 0.5% above its lows, it goes at least another 1%. And that has been observed and understood and pointed out for decades. Claudia Sahm, is it Claudia? Anyway, the Sahm rule has been celebrated more recently, which basically states the same thing, but it's not exactly a new observation. But that's where we are. We have the unemployment rate headed higher, and so that turns everybody's attention more to the unemployment rate and the question of, well, when is the Fed going to go and do the dovish thing? And so the monthly CPI report no longer has pride of place like it has had for a couple of years. It's still a pretty important report. Obviously, it's one of the two most important reports of the month, but maybe it's no longer number one, and that's sort of sad. But anyhow, last month, to review, core CPI had printed 0.29%, and it was 0.25% on the median, and that was lower than expected. And was generally sort of exciting. But as I said in my podcast last month, most of that was core goods. And going forward, if you wanted to see good inflation data going forward, it can't all be core goods. And it really was all core goods last month. And so that was the question. So coming into this month, the economists were forecasting 0.21% on the core. So they were all in that it wasn't just a one-off thing last month. It was going to be, we were going to keep getting these really good core numbers for a while. And so, and what I had said in the podcast was, look, you really do need to have the slower moving things coming along. So what happened this month? We saw a very weak headline number, very weak. So the headline number was deflation, minus 0.06%. And that was mainly the fault of actually the very weak core inflation. So we knew that headline was going to be lower than core because energy was going to be a drag this month. And it was about the right amount. I mean, we got the energy part right. But the core inflation was only plus 0.06%. So less than, I'm actually almost rounding down to zero. That's how low the number was. And that was the real surprise. And it's the second quite weak core figure in a row. And median inflation, which doesn't get reported, probably by the time you listen to this, it will have been reported. But as of this podcast, it hasn't been reported yet, but it's going to come in at roughly 0.2% month on month. Median inflation is a better indicator of kind of what the actual trends are doing. It doesn't jump around as much as core. Core inflation this month was we'll talk about why it was dragged down. It's dragged down by some one-offs. But median inflation being 0.2 is also a very, very positive thing. That's the best month-on-month median inflation we've had in quite some time. And if we could repeat that median inflation for a whole year, and you'd be at 2.5% or so on median inflation, and that's roughly 2% on core and PCE, and so roughly at the Fed's target. Now, and so so we're there, right? We got a month where we're kind of there. Now the problem is that if we were getting that kind of number just because of core goods, you're just not going to get 12 of them in a row. I've said that for a while, that core goods, it's minus 1.9% or 1.8% year on year. And I keep saying it can't go any lower, and then it goes lower, but I mean, there really is sort of some limit. But used cars was weak again. But the real question then, of course, is what happens to core goods, and in particular, what happens to shelter. And we've talked a lot about shelter on this podcast. That for a while, there's been this group, and a fairly large group, I guess, of prognosticators who believed firmly shelter was, it's already in deflation. It'll just take us a long time to figure it out. All of the fast twitch numbers all show massive deflation in shelter. And it just, and again, I've talked on the podcast a lot about this. I won't belabor it again, but there was never any real reason to believe that. If you actually go out and you actually talk to renters, or even worse, talk to landlords are not cutting rents. Their costs are going up. And while in certain markets, in certain buildings, at certain times, landlords will cut rents, it's just not broadly happening. There's just too much demand and too little supply for that to be happening, and the costs of landlords are going up. But that's not to say that the levels of rent inflation we were seeing were going to come down. And in fact, my model for a while has had rent inflation dropping to 2-ish before rebounding. That's a positive 2, though, not a negative 2. And if you're going to have overall inflation hanging around 2%, you need to have shelter inflation being not far from 2%. And so, but by the way, for a while, that's been my forecast, and for a while, shelter inflation it's been decelerating, but not as fast as my model thought, not as fast as a housing lag model, house prices lag model would have suggested. And it was kind of a conundrum. Well, this month we finally got shelter numbers that are more the sort of shelter number that we would need to see going forward. At least showing that there's some deceleration. So primary rents, that's rent to primary residents, were up 0.26% month on month. Okay, last month it was 0.39, so that's a substantial deceleration. Owner's equivalent rent was 0.28% this month. It was 0.43% last month. So again, these are substantial decelerations over just a 1-month period, and that dropped the year-on-year rates to 5.07 and 5.45% respectively. Now, the month-on-month numbers probably aren't going to get lots better than that, but the year-on-year figures will come down because of base effects, right? If you can just get 0.25% a month, then you're running at roughly a 3% level year-on-year, right? So 0.25 times 12 gives you roughly 3%. And as I said, I think it's going to go a little bit lower than that, but we're not going to have a dramatic improvement from here probably on monthly shelter prices. But at this level, we're going to see enough from the base effects that you are going to continue to see core inflation year on year decline and the shelter inflation decline. And so that's really good news. Not unexpected. We expected that to happen. We've actually expected it to happen earlier than now. Okay, but it's happening. And it's one thing to expect it to happen, another thing to have it actually happen. So that's all good news. There were also some sort of one-off that will be reversed. We had a 2% decline in lodging away from home. Lodging away from home jumps up, jumps down. It's all over the place. So minus 2%. We're not going to drop at 24%, over the next year. And airfares dropped 5%. Again, they're not going to drop 60% over the next year. So some of that is jet fuel prices, but we're just not going to see airfares drop that precipitously. We may see them drop a little bit because one of the reasons they have been held up as high as they have been has been that there's a shortage of actual aircraft because of all the Boeing problems and recalls and things like that. And so the fleet has been fairly tight. And when the fleet is tight, it means that airlines can afford to keep fares higher, and some of that's beginning to relax, and so you'll see airfares probably not continue to rise at the rate they were, and maybe even come down a little bit. But 5% a month is a lot, and that's not going to continue to happen. So anyway, we talked about shelter, and the other big thing that we are concerned about, and I mentioned, by the way, lodging away from home, and I mentioned airfares because, those are in core. And so that's one of the reasons that core was exceptionally low. And by the way, yet another reason that we look at, a good reminder that we look at median because of the outliers. We don't want to focus too much on the outliers. But let's look now at Supercore. So that's core services X shelter. And people made a whole, and this is where when you listen to other people's analysis today, if you listen to them last month, a lot of people said, oh gosh, Supercore, core services were exceptionally good. And so that's great news. That wasn't the story last month. The story last month was core goods. Core services X shelter on a month-on-month basis was good last month, really good this month. It's actually, on a rounding basis, was actually slightly in deflation this month. And if month-on-month mattered, then that would be really, really exciting. But it doesn't, and this actually looks like a seasonal adjustment problem because so we had this really low Supercore May, really low Supercore June. Hey, guess what? Last year, you know what the two lowest months were? May and June. So it looks like there is some, and if you look at the chart, May and June were lower by a fair amount from everything else last year. That looks like what's happening here. Maybe not, but there's a good reason to not get terribly excited about the Supercore yet. So, if you look at individual pieces, you look at medical care services. Medical care services is up 3.3% year on year. Doctors' services are steady and positive. Hospital services steady at 6.5 to 7, and those were surprisingly low for a long period of time. And so now they're actually kind of making up for lost time, and they probably will continue to do that. So I don't see Supercore suddenly collapsing back. On a year-on-year basis, last month the rate decelerated slightly, and this month it decelerated slightly. And again, the only reason that year-on-year decelerated slightly instead of a lot was because we had last May and last June were also really low numbers on the Supercore. So again, overall, core goods continues to be great story, but that's a limited story. Shelter, good story, expected, was delayed. It's nice to see it show up. Supercore, still not really doing what we need it to do. If wages start to come down because unemployment goes up, then eventually Supercore will start to abate a little bit, but it's not there yet. It's not really doing what it's supposed to do. But all that being said, there's nothing wrong with today's figure. There's no weird little fly in the ointment. The 5% fall on airfare is probably going to reverse, but there's nothing here that makes you go, oh, okay, this whole number is just like bogus. Okay, it's just that a lot of the stuff we sort of thought was going to happen is starting to happen now. And overall, there's no question that if you're at the Federal Reserve, this is a soothing number. If you're a congressman, running for re-election, this is a soothing number. If you're the average man on the street, you're looking at actual prices, you really don't care about the number. But for the policymakers, this is good. This is a good number. Inflation is decelerating. It's been decelerating for a while. So this is sort of the next chapter. And this really is sort of the next, if we can get this for another few months, then you'll start to say, okay, we really have sort of maybe downshifted what looks like to sort of that 2%, magic 2% kind of level. Here's where there's, and by the way, because this is soothing and because the unemployment rate is going up, there's very little question that the Fed is going to ease sometime in the next couple of months, at least a token ease before the election. I don't know how far the Fed eases over what time period depends on a lot of other things. And one of the things it sort of depends on is whether or not inflation continues to kind of be go down and stay down for a long period of time. For a long time now, I have said I expect median inflation to settle in the high 3s, low 4s. But go a little bit below that, before coming back up to that level, right? So because of the lag in shelter, we're going to go below that high threes, low fours level, but I think we'll get back up there. What could change my view? So when the Fed looks at what's happening here, they say, oh, we've done it. We've cracked the labor market a little bit. Unemployment rates going up. That's why, therefore, wages are coming down. Therefore, inflation's coming down. That's not the way things work. Wages follow prices, not the other way around. There's a feedback loop, and so it kind of matters, but it's not. But that's not the reason. As I just have spent the last half hour pointing out, the reason inflation is coming down right now is because of shelter, not because of core services. So it's, the Fed will get happy about this because they think it's playing to their playbook. Once shelter has done what it's going to do and starts going back up, then that kind of goes away. For me to get excited that we are really going back to the old 2% kind of level, what would have to happen is that money supply, which had been contracting for a while, but is now expanding again. Money supply growth needs to stay kind of low. And we have to kind of get to the end of the velocity rebound. And the velocity rebound is eventually going to run its course. We're closer to the end than the beginning. And when it runs its course, if money supply growth is still low, then you can get a nice result from inflation. I'm skeptical that that's all going to work out in such a beautiful way. I think it's going to be very hard for the Fed to keep money supply growth that low, given some of the fiscal challenges that we have. But you know what? That's not this month's problem. Okay. For this month, let's celebrate. We got a nice inflation number. Obviously, the bond market is celebrating. The stock market was celebrating initially and now not so much. So I'm not sure what you guys want. Equity traders, don't get it. I'm not sure what you want. But anyway, but for this month, it's the inflation is giving you what you should want. And that's all I have to say. That's all for today's podcast. If you like this analysis, you got anything out of it, please like it on your podcast app and refer others. Subscribe, hit the subscribe button. You can contact me if you have any questions at inflationguy@enduringinvestments.com. You can subscribe for free to the blog at inflationguy.blog, and I'm on Twitter at inflation_guy. I don't do nearly as much as I used to, but my comments and stuff come out there. Please visit our sponsors, Enduring Investments and Simplify, and most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.